Sometimes business reports strong revenue, clean profit, and growth. Everything looks stable. Then months later, the business struggles. What changed? In many cases, the warning signs were already there, just hidden inside the numbers. Many businesses appear financially healthy right before they experience serious operational problems. Reports show revenue growth, profit exists, and on paper, profit exists on paper, and the numbers appear stable. To someone reviewing statements quickly, nothing seems wrong. But financial statements tell only part of the story. They summarize activity that already happened, not the pressure building inside the business right now. In this video, we will explore the why numbers can look healthy while risks quietly develop behind the scenes, and how small business owners can read the signals more carefully. Financial statements influence many decisions in a business. Owners review them before adjusting pricing, hiring staff, expanding operations, or investing in new tools. Because of this, the accuracy of interpretation matters just as much as the numbers themselves. However, financial reports usually reflect past activity. By the time they are prepared and reviewed, the situation inside the business may have already shifted. When decisions rely only on past summaries, early warning signals may go unnoticed. Understanding this delay helps owners ask better questions and observe pattern earlier. A useful way to think about financial statements is to compare them to a rear view mirror while driving. The mirror shows where the car has been, but it doesn't show what is about to appear on the road ahead. Income statements and balance sheets operate in a similar way. They summarize events that already occurred during a reporting period. That information is important, but it doesn't automatically reveal what may be developing in the current moment. Operational changes often happen before those changes appear clearly in the reports. Many people assume that if a business shows profit, it must have enough cash available to operate comfortably. Profit and cash movement are not always synchronized. Revenue may be recorded when a sale is made, even if the payment arrives weeks later. At the same time, expenses such as inventory, salaries, or services may need to be paid immediately. This timing difference means a business can appear profitable while still experiencing cash pressure behind the scenes. Timing differences can gradually create operational stress. If customers take longer to pay while expenses remain immediate, the gap between incoming and outgoing cash widens. Financial statements may still show revenue and profit during this period, so the situation can appear stable on the surface, but internally the pressure builds as the business works harder to maintain operations while waiting for payments to arrive. Monitoring these timing patterns can reveal important signals early. Growth often feels positive and encouraging for business owners. However, rapid growth can sometimes hide inefficiencies or operational weaknesses. New revenue may temporarily cover older financial gaps, making the situation appear stable. But if systems, processes, or cost controls are not keeping pace with growth, pressure can accumulate underneath the surface. When growth slows, these hidden weaknesses can suddenly become visible. This is why experienced operators watch both growth and operational stability together. Financial statements focus on numbers, but they do not always highlight the underlying dependencies within a business. For example, they rarely show whether a company relies heavily on a single client, supplier, or operational process. These types of risks can remain invisible in financial summaries. Business might appear stable in reports while depending heavily on one key relationship or system. If their dependency changes suddenly, the impact can be significant even though previous statements looked healthy. Recognizing these operational dependencies adds another layer of understanding beyond the numbers alone. Reading financial statements more effectively does not require complicated models. In many cases, simple monitoring habits can provide valuable insights. Comparing profit trends with actual cash movement can reveal timing differences. Observing how quickly customers pay and how quickly expenses occur also provides useful signals. Reviewing these patterns regularly helps owners notice changes before they grow into larger issues. Small observation habits often lead to clearer decisions. Financial statements are valuable tools, but they represent only part of the business picture. They summarize what has already happened. To understand where the business may be heading, it helps to combine financial data with operational awareness. When numbers are interpreted together with trends in payments, costs, and operations, the overall story becomes clearer. The goal is not to distrust financial statements but to recognize that they are summaries rather than complete explanations. Developing this broader perspective helps business owners make more informed decisions over time. Thank you very much.